so many young people are missing out on that first house. They're just choosing to have that freedom and flexibility in the world of online lenders, right? And just getting yourself approved quick on, rocketmortgage.com. How do you, what advice do you have for those people that are just getting started? Hey, welcome to Getting Real with Jason Gorman. I'm your host, Jason Gorman. Brian, you know that.
I do.
And joining me today is my good friend, Brian Connors. How'd you choose lending? How'd you end up in that?
Definitely didn't choose it. Went to college for finance and economics at St. Thomas, and that got me an internship at what was First Bank, which became U.S. Bank while I was there. And they had a big international banking department. And during college, they encourage you to apply for some sort of an internship thing to get some experience prior to graduating. So I did intern at U.S. Bank for 3-4 months in their international banking department, and they offered me a job before I even graduated. So that sort of just stumbled into. And but that was back when, banks were consolidating, and they weren't growing by growing. They were growing by firing people, make the bottom line look better.
Right.
So it was really cool for me. So I took the job of two guys that were making 3 times what I was, and they paid me, $38,000 a year to start, and I'm sure they were paying both of them 70 plus.
Right.
Fired them both. I did all the work. It was an awesome learning experience, dealing with big clients, big customers, all commercial stuff. And learn a lot about the world because I had to read like 4 newspapers a day and all geopolitical stuff, which relates to international banking. But that got really tiresome when the raise was going to be 3% and they continued to pile on more work. And so I just said, I got to find something that is going to reward me for my efforts and that'll have some reward for efforts, I guess, would be more of it. And, it's tough dealing with commercial clients because commercial things are just transactional.
Okay.
And they're just about the numbers. And I like numbers, don't get me wrong, but you lose a lot of that personal relationship. And I was encouraged to get into mortgage both by you. You had been in real estate already. My dad had spent a lot of time in real estate, both residential and commercial. And the interaction with people every day is amazing, and there is some emotion involved in what we do. And on the commercial side of things, it wasn't. It's just, do the numbers make sense or do they not, right? Whereas on the residential side of things, at least in mortgage and real estate, in my opinion, there's passion because you're going to live there, you're going to raise your family there, and these aren't just the business finances you're talking about. This is your household finances you're dealing with, and that becomes much more intimate. And I just love that part of it.
So a little bit about your family, right? You had a baby at that time. You're probably like, hey, I got to start making some money here and quick.
Money, yeah.
$38,000 won't cut it when you're raising a bunch of little kids.
The world was different, though. Remember what house prices were back in 1997, 8-ish, when I bought my first house for like $130,000.
Yeah.
And that was prior to getting into this business. You could qualify for a house.
Right.
And it was a 4-level split, nice 1,800 square feet. Yeah, those don't exist anymore, of course. But
so what are the biggest mistakes you see people that get into, mortgage? I mean, you see people come in, just like in the real estate business, we have so many people get into the business. What are the biggest mistakes you see people make getting into mortgage as a career?
That's a tough one because there aren't a lot of people getting into mortgage. That's part of the other issue. We're all getting old. Not as many young people in it. I think part of it is your inability to go out and attract business to yourself, right? So getting any job doesn't just give you business. And it's partly a sales position, right? And you need to have the personality to shake hands and shake trees, right? To get people to like you and want to refer business to you.
Look for business.
For business. The other thing that I found I was able to be successful at when you're brand new is I'm smart-ish, right? I know enough about finance and numbers. And
did that help you?
It
having
helped
gone
a lot,
to school,
yeah.
that made the transition into the business.
It did, and it helped more at the beginning than anything else because I was dealing with, you'd get a referral from a successful realtor. The history of mortgage transactions is primarily, and it's still primarily the case, people don't determine what they're qualified for first. They call the realtor and say, can we look at houses? And the realtor goes, hang on, knucklehead. I don't know if you can qualify. Go talk to a banker, right? And they refer a lender to have that conversation.
Okay.
And I got leads that were all of the, for lack of a better term, less than perfectly qualified individuals,
Okay.
right? And to cut my teeth on, right? Because they'd say, well, let's see if Brian can handle this really complicated one before we give him our 3M executive that wants to buy $1 million house, right? So I spent a couple of years dealing with just those clients, and that is how you learn the business. It's not dealing with somebody that's a A-plus buyer that takes no energy and effort to get them qualified. I spent months with clients fixing credit and paying off debt and consolidating this and doing all the right things and the hard effort and work and writing letters of explanation about all their crass past credit dings. And
So when you look at like the buyer complications, or just even people that have a little bit of a touchy situation, what advice can you give to people, right? So it's a buyer that's out there thinking of buying a house. What should they do? Like what questions should they be asking to make sure that they've got someone who can help them navigate that process in the world of online lenders, right? And just getting yourself approved quick at rocketmortgage.com. How do you like, what advice do you have for those people that are just getting started?
Yeah, any lender can get you a loan, right? And that's an interesting comment. That's an interesting question I wasn't prepared for, but it ties into something I was going to say anyway, which is that I get a lot of clients who have met with another lender, and oftentimes it's the Quicken loan or the Rocket Mortgage.
Yep.
Hey, we applied online, we called, they said you're approved, go buy a house.
Those are the approval letters that we are most afraid of,
Of
because
course.
I deal with a lot on the listing side of things. And, we get really afraid of those online lender approval letters because and the only reason is we're just not 100% sure they talk to anyone. You know what I mean? So maybe no one understands their situation, or maybe no one checked the fact that do they even have their job, right? Have they been there for 3 months? Have they been there for 3 years?
Yeah, and that's the difference. So they call me after being referred by their agent who says, let's not deal with Rocket Mortgage, right? And I sit down and the first question I ask them is, what type of financing are you doing? I don't know. What advice did they give you? I don't know. They just said, here's a letter, go buy a house, and here's how much cash I need. I don't like that part of the business, and that is the way a lot of it is going.
Yeah.
But that client has no idea what they're getting themselves into. Now, the reality is I might go through an intricate process and describe 15 different ways you can get financed, and we may come to the same conclusion, but when they're done with my conversation, they've got 4 spreadsheets in front of them that they now know why we came to that conclusion, as opposed to me telling them what they need to do.
Right.
They now understand, oh, that makes sense. Here's why we're going this direction. Here's what the best type of financing is. Here's why we're doing this down payment assistance program or not, et cetera, right? So that is, I think, the biggest pitfall people are going to have is dealing with the online lenders. The other issue is the online lenders don't really care or have a vested interest on whether you close on time or not.
Yeah.
Because there's no one holding them accountable. I'm going to be your neighbor potentially, right? I live in your neighborhood. I have relationships with the realtors. We know people. I have a vested interest in making sure you get the best product available for you. And then most importantly, which especially first-time buyers don't understand, is closing on time. And that doesn't always happen. You've got experience.
I've told you that. Like, I got an email literally 10 minutes before we sit down, and we're not closing today. Mm-hmm. It's been scheduled for 2 months. But they just don't have the appraisal back.
Sure.
Just a couple of things. Maybe, and the email is just like maybe with the holiday.
Yeah.
Like as if Memorial Day showed up. It's been on the schedule all year.
I've heard that's been a holiday for a while.
It's really, really it's a thing. It comes around the same time every year.
Almost exactly.
And so, we're not going to close, not that we're going to close tomorrow now.
No, we'll just close
maybe
eventually.
Friday.
Sure.
Maybe Friday. Yeah. So, and this is what you get, and unfortunately, someone forgot to look at the files, ultimately what happened, right? Underwriting probably looked at it today.
Yep.
And they told us last week via email that everything was done, everything was back, everything was fine. But that was a different person than was looking at the file the day of closing.
Sure. Brilliant.
So that's really the issues that we have. And like you say, as long as you don't mind, floating until the day of or the week
Sure.
of closing to find out you're having a 1 or 2 day delay. 1 or 2 day delay when you're moving your family, when you're refinancing, that's not a big
life-changing.
deal, right? If you're refinancing your house and you already live in it, then a 1 day delay on your refi won't matter.
Yep.
It really matters when you got the U-Haul out front, or in our case, the free moving truck we provide. You got that parked out in front of the house. That's a really bad day.
It's a really bad day, and it makes everybody look bad.
Yeah.
And
So-
but people gravitate towards online something because they think they're going to get a better deal, is what I think the initial thing is.
Do they?
Like, I think that's what people think.
Do they though? When
Absolutely
because
not.
you meet with people
Absolutely
obviously
not,
that
no.
have
So-
already gone on Rocket Mortgage. Do they get do you end up saving them money or get the same loan for the same cost
Generally
sometimes?
get a better deal working with the local lender who has a vested interest. Now, Bell is a big lender, right? So the reality is that it's too competitive. It's no different than if there were 3 Toro dealers on 3 different corners, 3 gas stations on 3 different corners.
Okay.
The gas price is going to be the same because it's just too competitive, right?
Okay.
So the dollars for dollars is very, very minimal. There can be a little difference in cost, $200-300 from one lender to another,
But it's not a substantive difference.
absolutely not.
Okay.
Absolutely not. No.
So when is the right time, for someone that's getting started, or even if, even they're moving up, right? So we deal with people, you deal with young buyers, first-time buyers. We deal with a lot of move-up buyers.
Yep.
When's the right time for them to start looking for a lender?
As soon as they think about it, really, right? That the history, as we mentioned before, is call your realtor first. The reality is you should talk to your lender first so that you can have an educated conversation with your realtor about what you're going to do. But don't wait too long. I've had, many clients that are excellent A+, generally speaking, buyers who have a credit glitch that they didn't know about. Their EFT payment to XYZ didn't go through, and now we got to deal with getting credit score repaired. And so the bottom line is the earlier the better. Your credit is good for 120 days, so it's not like lenders are going to just keep pulling your credit report. It's good for a while. So I always recommend.
And is it good? It's good to put together a plan, right? I mean, so if you're
Always.
thinking of doing something, it's good to just start in advance, so you're not, having to be reactionary or need to hurry up and figure it out quick in one day.
We can do it quick though too. There are circumstances where, hey, we weren't thinking about moving, but this house came on the market, and
Yeah, we apologize.
can we
for
do
those.
that tomorrow?
It's usually when you're camping or something. We need you to
Right?
get out of your tent,
It's
get
just
some
the way
cell
it
phone
is.
signal, and get the thing done.
Just the way it is.
Yeah. Where do you see, so where's the market today? Obviously we have an increase in interest rates the last 18 months. Where do you see the market going, or where do you see the rates going?
Not happening. Not much happening in the near future, it appears. The Federal Reserve is balked at making any rate cuts. Now, the Federal Reserve is one impacting factor to what interest rates are, right? So, but it's a mover. If the Fed says they're going to drop rates instantly move. They've talked about potentially 1 to 2 rate cuts towards the end of this year. Who knows if that'll happen? We're in a weird year right now with an election, with inflation.
What election's good or bad for rates? Or do you think it's not going to matter?
Generally, I don't think it's going to matter this year. Often, even the Federal Reserve, in my opinion, attempts to not rock the boat much during an election year. What they don't want to do is lean in somebody's favor.
Well, and isn't it true? We've, I was at a conference down in Austin, Texas a week and a half ago, and it's about half the people aren't going to like whatever happens with any election.
You are correct.
So no matter what happens, you can rest assured about half the people aren't going to
We'll be unhappy about it.
Right. So, that's, really what we're up against in most elections right now. But when you look at the rate climate, I think we talked about this 10 days ago, people don't realize when the Fed stopped buying the mortgage-backed securities, when they stopped basically artificially keeping rates down,
100% they did.
that's what happened. And I think people think that we're going to start to see this giant drop in rates because that would work better for their brain.
Conversation with just about every client. They're like, well, what do you think? Are we going to get back to 3% again for 30-year fixed rate mortgages? No chance unless we have another pandemic. You're exactly correct. Interest rates only fell to where they were because the government forced them to do that. So they spent a lot of our money, look at the federal debt, driving down interest rates, and I think that was a once-in-a-lifetime thing. I hope it's a once-in-a-lifetime thing, not for interest rate purposes, but who wants COVID again, right?
Hey guys, sorry for the interruption. If you like this content, please subscribe to our channel. Now back to the video.
So yeah, we're not going to see those kind of rates. And you look at what if interest rates averaged over the last 30 to 40 years? In the 6% range.
Okay.
And where
when we
rates
looked
now?
at it,
in the mid 6% range.
Yeah, 6.6 or 6.7, I think, was the 30-year average.
Yep.
Right.
So to say that right now, if you can get a 6.75% to 7% rate, is something crazy. What'd you pay on your first house? Do you remember?
No.
Yeah. Well,
I mean, that's a funny thing.
I was 8.9%, and I think that was in 1998, maybe. About that, and that was fantastic because they had just come down from 11 or 12.
Yeah.
Very recently, prior to that. So what a smoking
I remember
deal.
when we built the house we're in now. So we built that house, and I want to say, and you did the loan, whatever, 100 years ago, and I think that was 6 something, maybe 6%.
Probably in that range. What year was that?
It seemed really
1 or 2 or something like that. Probably.
That was 99.
99. Okay.
Yeah.
Yeah. So I think the reality is we're just sort of at the new norm for a while, and don't expect rates to fall significantly in the near future. Trying to predict what's going to happen next year is impossible.
Right. Well, and I mean, the thing to consider, right, for a lot of people, if your alternative, and this isn't to say, okay, interest rate 7% or 6.5%, 7% is great, but the alternative, if the alternative is to just live with your buddy for free, well, then maybe you don't do it. But if you're paying rent, right, I mean, that's 100% interest. I've got a place that I just came vacant right now. I'm putting it on the rental market right now. And I mean, I'm $600 more per month than I was 5 years ago when I bought it.
Yeah.
It's like that. So I just keep raising the rent and people keep paying it. Rents continue to rise. And that's really, I'm just going to where the market is.
Yep.
I've raised it a few times. I've had 3 different tenants over the last, it's almost 6 years. But you just look at that, that's $600 more per month.
Yep. What can you get for a rental payment? What are rents right now? I've seen $1,819 people spending $2,000 a month in rent right now.
Yeah, this is $2,100. This is $2,100 on a 2-bedroom, 1-bath, 2-car garage, single family home in Lake Elmo.
Convert that to buying a house. Depending on what you put down, you could be spending $225, $250 for the same payment.
Yeah.
Townhome, single family, range. Why not buy something?
Yeah.
And
you lock in your
Jason,
payment.
there's a reason you own rental properties.
Well,
Why?
when you lock in your
makes you
payment,
money.
and I think that when you look at it, if you lock in your payment, one of the big kind of keys to wealth, right, is being able to lock in your payment. So when you do get that 30-year fixed, rents won't stay the same for 30 years. They won't even stay the same for the next 5 or 10 years, right? So they're going to just keep chicken up. And even if it starts to slow down, maybe they don't raise rents for a couple of years, right? We might see prices stall out and from going up in terms of appreciation. We also could see rents kind of freeze, but they don't go down.
Never.
Very seldom does anything go down. Even when we saw the market correction from 2006 to 2012, we never saw rental rates didn't decline.
Sure.
Right? They got flat for a few years. And that's the thing that people have to understand is it's like, so as you continue to keep paying rent, a lot of people that we meet with, they've been paying rent for 5, 6, 7 years, and that's gone up $50, $70, $80. And, each year, but you're stuck, you got to move your stuff. And so the moving part becomes the reason you stay.
And what did they miss out on? Even if appreciation was at a 2 to 3% per year rate, which it's averaged significantly more than that in the short term. What did they lose over that 5-year period?
Yeah.
A lot of money.
Yeah, and that's, where we see, because right now in the real estate, in the Twin Cities, we see, 35, maybe 37% fewer homes selling, right? And those are the people that were moving because it was Thursday or Friday or, maybe they just, had a good weekend. And so they're like, oh, we should get a cabin. So you had a lot of extra homes, right? So you still have 2/3 of the people are moving because they have to, or they really want to. And the other extra third of people that we've seen in terms of the drop, those are people that didn't really want to move. You don't need to make yourself move, but if you're on that time horizon, and I tell people you're going to move at certain stages in your life. 35 and 40-year-old people don't usually want to still live with their parents. It can happen, right? I mean, the goal, right, is to shoo them out of the nest. And so, somewhere in their 20s or maybe early 30s, they want to buy their first place. And that's been getting a little bit later. You've seen first-time buyer, the age has gone up for the last 7-8 years because there's so much more college debt. Are you seeing that affect people's ability to buy? Is just being straddled with a lot of college debt?
Absolutely. That's been now we can get into a long conversation about college debt because we probably agree. But during the pandemic when all that debt was gone, well, not gone, but all the payments were deferred, no payments required. And guess what we as lenders were allowed to do? Effectively ignore your mortgage payment or your student loan payment from a qualification standpoint. Not completely, but suddenly those payments now came due, and that absolutely changed what buyers can do.
Is that affecting? So you're seeing that on the weekly basis. People just can't get approved, or maybe aren't approved for as much,
or their buying power is just less.
Okay,
that's exactly right. So what they were.
Are there any ways around it? Like, is there anything creative that people can do to either put themselves in a better position or to, maybe qualify for different programs?
With regard to student loan debt, are you saying, or just in general?
Just in general, like being able to increase what they're buying, basically improve their buying situation.
Well, and I deal with that all the time. We can be restructuring existing debt. We pay off car loans with better rate loans. Car loan rates have come down a bit. That's one piece. So if you can drop here's just a little math example. About $100 a month in debt changes by about 15 to 20 grand in what you qualify for your house.
Okay.
So if you can restructure some credit cards and pay off another outstanding thing and redo a car loan, we can easily increase by $200 to $300 a month what somebody qualifies to spend, and that could translate to 50 grand in mortgage qualifying. So that's one big piece, right?
So that's one of the a hack for
behind the scenes hack, absolutely.
Yeah. So if they got a 7 or an 8% car loan and they can drop it to 5% or something, I don't know what car loans are at.
Or change the term, et cetera.
Okay.
Or lump some other things together. That's one piece. There's no magical options. You can do buy downs on rates a little bit.
Do they work?
They do. They do. It's not common because you've got to get a seller to contribute the money for the buy down. And right now, our sellers contributing to closing costs, not a ton. Our sellers willing to pay buy downs, probably not a ton right now because the market's competitive enough.
Yeah.
They're going to wait for the next buyer that doesn't ask for that. But so there's lots of creative things we can do. They're not great options right now. There are plenty of down payment assistance programs available. I'm coupling somebody in Woodbury right now with $30,000 from Woodbury and $16,500 from MHFA. They're both loans that have to be repaid back. The Woodbury money is at 3%, but that increases your effective down payment, removes PMI for that client that saved them $130 a month, and then the $16,500 from MHFA is no interest, no payment. So we effectively increased by $50,000 or $60,000 how much that client could buy.
That's huge.
Were they not using the money?
Are there a lot of programs like that? I mean, I know specifically the Woodbury one, and then Dakota County has their bond program. I mean, there are different programs all over.
We have a list of 40 or 50 of the programs that exist, and we're on top of them all. We have specialized people at Bell that keep that list updated constantly as to what's available, what the guidelines are, what the requirements are. They're not always easy to qualify for, and every one of the programs have different qualifications from an income standpoint, or how much money you can have left in the bank after you use their money, or credit score requirements, or will they couple their money with MHFA money? MHFA, by the way, is sort of the statewide program that's used for everybody.
So Minnesota Housing.
Minnesota Housing Finance Authority. But even that, it's complicated, and you need to deal with the lender. Good luck getting Rocket Mortgage to have any idea what those programs even do. They don't even know they exist.
Well, and knowing the difference, because I think
Woodbury is. They barely know where the state of Minnesota is.
Right.
But you got to understand those programs, couple them together. They're complicated to use. You're dealing with government agencies and city agencies oftentimes. We're one of the biggest lenders, probably the biggest lender for most of those down payment assistance programs. So they know Bell, which helps.
Yeah.
They answer my call or return my phone call if I call them. But yeah, those are some of the best ways. It's restructuring debt. It's fixing credit. Credit can have a big impact on what somebody qualifies for as well. There's the average Joe might qualify for a certain debt to income ratio, which means they can spend a certain percentage of their income on their house. But with crappy credit, you're not going to get that high, right? So fix people's credit, consolidate debt, take advantage of down payment assistance programs. If the market changes using things like buy downs as well, those are the biggies.
Didn't you say, was it last week or maybe the week before when we were at our networking meeting, something about second homes or the rates on second homes?
We talked about down payment requirements for second homes and investment properties.
And those have dropped.
And those have dropped. Yeah, traditionally it was 20 to 25% down, certainly for investment properties, and we can do significantly less than that now. The qualification parameters are tight. You got to be a pretty qualified buyer to take advantage of those minimal down payment investment property loans. But the fact that lenders are now willing to
you could buy an investment property with less than 25%
absolutely can now. Yep.
And then what was the deal on second homes or?
Interest rates for those investment properties was actually better than buying a second home. Yeah, so that's been strange as well, but fantastic.
Are you seeing a lot of people doing like the short-term rental or the investment market? I mean, do you see a lot of people doing the short-term rentals right now?
Like doing VRBO stuff?
Yeah, VRBO, Airbnb.
Yep. Buying a lake home and making huge money on it.
Because that's a big thing, I think, from an investment standpoint. A lot of people don't realize, maybe they've never done it.
Oh,
they thought maybe it was a get-rich-quick
tenant kind of thing. Now, I don't own a VRBO, but I've had plenty of clients that do. It's probably a little bit more involved from a management of the process standpoint, unless you're doing it directly through Airbnb or VRBO. But boy, the profits on that stuff, cabin rentals have gone through the roof since COVID. I think COVID really expedited that. And I think there's a yearning for some people to not want to own a lake home because it's work.
Yeah.
And it's taxes. And, oh, gosh, maybe we'll only get there 3 times this year, and I just spent $500,000 on a cabin. I myself, we rent a cabin every year in a different spot, and we spend pretty good money doing it. But guess what? It was for a week. I'm done. I don't have to fix the dishwasher.
But for a lot of people, right? If they could get 20 people that are willing to pay,
own that,
right? 20 people that pay $4,000 for the week is $80,000 in income.
Yep.
All of a sudden, you start running that math. That's only 20 weeks a year,
and they keep enough weeks for themselves. Where they're
there's 32
there
weeks
for the
left.
same 3 or 4 weeks they would have had they owned it and never VRBO'd it.
Yeah.
Right. So it's.
We see a lot more people asking about that, because I think that really when you're looking at the cabin kind of lifestyle, to your point, like I think a lot of people just wonder, will I get there enough to justify it?
Yep.
But if you get there 3-4 weeks a year and you keep, say, 32 weeks available for yourself, right? But your prime 20 weeks or 20 of the prime weeks, you rent it out.
Yep.
And you make decent money.
Oh, they make plenty of money.
What other things what did I not ask, or what other things do you want people to know about the mortgage industry, mortgage business, and kind of like what do you see, the biggest mistakes or pitfalls people make?
I can tell you a lot of good stories. Pitfalls. I had a client quit his job 4 days before closing. That's a pitfall. So generally speaking, you're going to want to continue to be employed through the day you take out your mortgage. Go ahead and quit after that day.
What happened to that?
That one did not close. Yeah, he quit a job, didn't have another job.
He didn't think that would be a big deal?
Not sure if he quit or was fired. You never know. But the verification of employment just said no longer employed with us. I've had some creative individuals. I had one not terribly long ago where this person worked in the HR department of a rather large firm that everybody would know around here.
Yeah.
And their department sent over the verification of employment.
Okay.
Everything about the documents looked a little off. Can't say exactly why. They just looked a little off. Even the logo on the document didn't quite look right.
No.
Oh yeah. Said all the right stuff. Was signed by an individual. So we decided to make a phone call to the number listed on the verification of employment document. We call the number. It's Hobby Lobby, let's say.
Oh no.
Was the phone number listed on the thing, and that was So that transaction, needless to say, didn't close either. So I would just encourage you. Don't fake your documents.
Fraudulent, quitting your job.
Plenty of clients have taken on additional debt prior to closing. That can kill you. Oh my gosh, I didn't know that buying a new $60,000 car when I was barely qualified to buy this house was going to impact my ability to close.
Buying a car, people don't realize, and we have a whole thing that we send them, right? Like, just don't even go apply for a furniture loan. They think, well, we just got a $10,000 credit limit at Home Furniture. We didn't buy the stuff yet.
Credit limit won't impact you, but the credit pull may have affected your credit score. Right?
Okay, so even if they did a credit limit, in this case, it did affect someone. So maybe it was just someone right on the edge for a credit
might have been
score.
A score thing. Yeah. So that's the other thing to keep in mind is credit scores. Your credit score is good for about 120 days with the lender. Keep in mind, I encourage everybody to go on Credit Karma whenever you can, or something like that, and get a free credit score.
Is it accurate? So is Credit
Karma? It's not
Karma
perfectly accurate. That's the funny thing, right? So let's just use Experian as an example. They issue about 6 credit scores for you. So you actually have, just through that one credit bureau, about 6 credit scores.
Okay.
One credit score is used for your car lender, another is used for a credit card application, another is used for your insurance company, and then there's certainly one used for a mortgage company. And then lastly, there's a consumer credit score that you're going to see when you log on and see creditkarma.com, right? It gives you a score. Those scores, generally speaking, are close to each other, but they're never identical. Why aren't they identical? Because what is a lender doing? A lender doesn't know you from Adam, and they want to know, are they likely to be repaid for whatever it is they're lending to you? So a credit card company probably cares a little bit more about your credit utilization on your credit cards, and do you make those payments on time? Car lender cares more about the car payments, right? Mortgage lender cares about mortgage and other things. So bottom line is those scores can be different, but they're generally close. But yeah, you're exactly right. Don't mess with your credit score unless it's the lender telling you to do certain things to help improve your credit score to fix it during that process. Yeah,
what are when you talk let's talk a little bit about fixing credit. Yep. What are the things that people can do to fix their credit? Like, what's the top 3 things that you notice that people could do just universally to fix their credit?
Well, the no-brainer is make your payments on time, right? But the bigger issue is that you could have 2 individuals that owe the same amount of debt. Okay, so one person has a car payment, a couple of credit cards, and a student loan. Next person has a car payment, a couple of credit cards, and a student loan. Client A, and they both owe exactly the same on both of them. Okay. But client A, their credit limit on their credit card is $1,000, $1,000, $1,000, and they happen to owe $1,000, $1,000, and $1,000.
Okay.
Client B has a credit limit of $5,000 and $5,000 and $5,000, but they only owe $1,000 and $1,000 and $1,000. Client B is going to have a massively higher credit score than client A because of their credit utilization. You're effectively, the credit bureau says, ooh, gosh, this guy has no access to any more money if he needs it. Therefore, that person's credit score is going to be much lower than the guy that owes exactly the same amount with exactly the same payments, but has access to additional credit. So I encourage people to, especially when applying for a home mortgage, keep your balances on your credit cards down to, at a minimum 50% of what those limits are, if you can help it, right? Because showing available credit, super, super important. So what do we do with client over here? He's either going to apply for an increase in his credit limit or open another credit card. If his credit score was bad, let's say, open another credit card that shows additional credit limit available but not utilized, and that score is immediately going to increase significantly. So those are some small things that people can do. Lots of things like old collection accounts that just don't want to go away can affect your credit, and then certainly.
Does closing accounts help? Like if they got 5 or 6 cards from stores they don't even really shop at anymore. Having that stuff, is closing that stuff or getting rid of them? Does that matter?
No, because technically it can reduce your score because you're removing credit availability. Right?
Okay.
So there's really nothing bad about having accounts open as long as they have a positive payment history and you're not maxed out.
So positive payment history.
Number one, make your payments. Yeah, don't max them out. Exactly. At least when you're ready to apply for a loan.
Yeah. Mm-hmm. Okay. What other tips do you have for buyers or people looking for financing our mortgages?
It's deal with a lender that's going to give you some advice, first of all, and talk through those options explicitly. I really think that's the most important piece, and do it early enough so that you have time to make fixes if you need to, deal with cash savings. And the other is I've had plenty of clients lose out on properties because they weren't pre-approved yet. And the house is on the market, it's going to sell tomorrow, and guess what? It's gone, right? While you're jerking around trying to figure out if you can get pre-approved or not.
Or you just don't feel comfortable. And I feel that's why we explain to people, like, you got to do it in advance, just because we don't want you to feel like you're making a rush decision or a mistake. Like if the last thing you want to do is figure out the numbers as you're actually submitting an offer.
It's absolutely true.
You need to feel comfortable, and if the lack of planning should not create an emergency, and it does. If you don't deal with it in advance, it does. It just constitutes this giant emergency when you're making an offer on a property, and you're just not prepared.
Well, and you're wasting a lot of people's time too. And again, these are emotional decisions for both buyers and sellers. I've had clients back out, well qualified, did that, made an offer on a property. We got them pre-approved the next day, issued the approval letter, and then they start really digging through the numbers and saying, oh my God, what were we thinking? This is not what I wanted to do. And then back out of a transaction. And think what you just did to a seller. I mean, put yourself in that position where, hey, my house is accepted. Sweet. We're going to sleep well tonight. We know what we're going to make. We're making an offer on another house. You're screwing with people's lives.
Yeah, a couple days later, people. And that's what I explained to the agent on the way here. I'm telling that, the person I say some of these companies, they just like shoot for a closing date. It's like that's an actual date, and there's a lot of people planning on it. You can't just you can't have the lender shooting for that date.
When they have no vested interest, that's what they do.
Yeah, no, it's a pet peeve of mine. I feel like that's the one thing that you should be held to is it's like this is the date that your client agreed to, and they should be dealing with the lender well in advance. Like if you can't commit to that date,
that should be a hard set date, man. Yeah. I mean, there are very rare circumstances that closing dates should be changed.
Yeah,
and there are certainly some things that are out of people's control. You get hurt or you're hospitalized or whatever, but. Yeah. 99.9% of the time, that should happen on time.
Yeah. Mm-hmm. So, like when we look at like the property values, right, have gone up the last, say, 10, 11 years. We've seen the market really, escalating for the last 3 or 4. Mm-hmm. But really, positive appreciation, which is good for sellers, and then buyers feel like, oh my gosh, our price is going to drop. What's your feeling on that? Like where prices are at right now, number one, do you feel like pricing could drop? And then number two, how do you keep an increased price? How do we keep them affordable? From a mortgage standpoint, people are buying payments, right? So number one, do you see prices dropping? Number two, how do you keep the houses affordable?
I don't know that I see prices dropping because that's such a rare occurrence. It's a pretty significant political and economic situation to see prices crash, right? I mean, it's happened twice in my career and yours as well, really. Yeah. And those were pretty big corrections where home prices were not the only thing being corrected. I mean, it was that was life-changing for everybody in that, 8, 9, 10 period. And so knock on wood, that doesn't occur again. And that's one of the benefits to home ownership is that you're not going to see, knock on wood, massive reductions in this asset you're buying. It's different. People spend a lot of money on cars, and guess what your car is worth 5 years down the road? Nothing.
Right. Yeah. That's for sure going down.
You make a big investment in a house, and you hope that property is going to maintain its value or appreciate in value. I do agree that it's less affordable today. And the problem with, I don't know how fixable that is, but as to the point we were making before, house prices are simply more expensive than they used to be. I look at what were average wages coming out of college for an individual 20 to 25 years ago, and what is an average starting wage for an individual graduating today. They've not doubled.
Right.
Not even close, right? So somebody might have made 30 or 40 grand graduating 20, 25 years ago, and now they're going to make 40 or 50 grand at that same sort of entry-level position. But what has happened to house prices in that time?
Yeah,
2 to 3 times.
Yeah,
that's difficult. So the things we discussed, taking advantage of, there are significantly more down payment assistance programs, but those mostly work for first-time buyers.
Yeah. But do you see people, and I think that you hit the nail on the head, where I feel like if you miss out on that first house, right? So many young people are missing out on that first house. They're just choosing to have that freedom and flexibility, right? That lack of needing to be, committed to staying in a certain spot or in a certain place. Because they don't have that, they don't have the appreciation of that home. They don't have that going up. They don't have that locked in price.
They're losing out all along.
And then in 7, 8, 9 years, now they're like so far behind because home prices, keep edging up, right? And so it's like it's becoming unaffordable for a lot of people. It's like if they don't get in, it just gets worse.
Oh, I agree with that entirely. Yeah. I don't know how you change that mentality other than educating, which is what we're trying to do right now. I have kids and their friends, and all of which are buying houses as well, right? But they're buying at a later time than you and I did.
Yeah.
They're waiting until they're upper 20s.
But it's
later.
hard, right? Because part of what helped you get into that second and third house was the first one going up in the first 8-9 years. That's the thing. Like when you miss out on that time, right? Not only did the property go up, but you also paid part of it down. Mm-hmm. You had a tax benefit. Like there's so many benefits that at the end, when you're done running the calculator, even though the payment was $200 more on that first home than it was on your rent, the net effect of that payment, because of the tax savings, the appreciation, everything, like you're in a radically different spot.
You're correct.
And that's the thing. Like you can't get back that 5, 6, 7 years while you're just waiting to get ready.
Which is why I encourage people to do it as soon as they can if they're comfortable with it. And getting comfortable with it means sitting down with somebody and talking about it more than anything else. You can afford to buy. It just depends on the lifestyle you want to live, right? And
well, and choosing wealth, right? Like choosing to be wealthy,
exactly
buying
right.
an asset that appreciates.
Living for today or living for tomorrow is part of the difference.
I literally just had this conversation with my kid because we were coming back and we were just talking about cars and trucks and like, what would he want to buy it? I mean, he's naming off a vehicle. I'm thinking, well, that's like what your mom or I would buy, like at an established age. Like you don't buy that kind of vehicle at 18 years old. Like the math doesn't math.
Right.
And
right.
And he still thinks it's a good idea. I think, well, I mean, when you look at that, so buying a depreciating asset at $60,000 or $70,000 keeps you from being able to buy an appreciating asset that someone else will help you pay off. Like
absolutely
maybe you don't buy a house that you live in, you buy a rental and someone else pays the darn thing off instead of a truck.
You are correct. And that's part of the other issue. We talked about student debt being an issue. Well, the other issue is when somebody waits until they're 30 before they buy a house, they're probably not still buying or driving a $2,000 piece of crap beater. They decided to buy a fancy car.
Right.
And it's like this
or even an average
circle.
Car. Now it's like an average car, I think, has got that.
They've got some student loan debt, and now they waited, and house prices are more expensive, and interest rates have gone up, and they got 2 big car payments, and they're, blah, blah, blah. It can be a vicious circle.
Yeah. You got to do it. You got to do it sooner, and that's the thing. When you buy appreciating assets, you can't do it soon enough.
You are correct.
When you buy depreciating assets, you should pump the brakes and think about it.
You need to wait until you just got excess
right?
funds to pay.
It's Memorial Day yesterday, right? So the car lots were full yesterday.
Sure.
Right? They're full. And that's the thing. Like people are they can't wait to go buy those depreciating assets, and then appreciating ones are like, well, I got to wait and get myself ready. Mm-hmm. And that's if you look at it just from a wealth creation standpoint, you've got to pump the brakes on things that go down in value.
Yep. And they've been taught to do that. Everybody's maxing out their 401k. They want to invest in the market right away, right? Which is fantastic. You should be doing that. Why are they not thinking that way with possibly the biggest asset they're ever going to buy, which is a house? Yeah. No, let's put that off. Really? Okay, wait to invest in your 401k till you're 30.
You look at the new apartment building that's a block away from here, and I think, and it really looks nice. I looked at it online. Yeah, I'm thinking it's $2,000 to $3,000 a month for an apartment. Mm-hmm. Yep. And I'm sure it's, got some swanky coffee bar area or something. I think,
that's got to be worth an extra $1,000 a month.
I know, and I just think, oh my gosh, they have $25,000 a year. And you have no tax. Well, you get your renter's credit. I mean, that's really your only tax.
Depending on your income.
And so when you look at it, that is when people are looking at buying their first place, you've got to really be able to look at the total picture from a number standpoint. Because again, it doesn't get less affordable the older you get. You just have to basically make those good financial decisions when you're
early.
Young.
Agreed.
Well, this has been awesome. We'll have your contact information in the notes below.
Sweet.
So anyone that wants to connect with you, they can connect with you that way. And thanks a lot for coming in.
Thanks, buddy.
We appreciate it. Hey, guys, thanks a lot for watching. Don't forget to subscribe to our channel. If you like this video, please like and comment below.